There's so much bearishness in the market. Today, we see Goldman Sachs and BlackRock saying, sell equities. Oh my goodness. This is like, I remember, this was very early in my career, 1982, Business Week magazine on the front cover saying, equities are dead. And now you have some of the biggest houses out there who would tend to benefit from a positive equity market saying, equities, don't go there. We think that the surprises, again, both inflation and interest rates are going to be significant to the downside. And we do think, even though we are in a recession, that it won't be as extensive. It's going to be much more of an inventory recession as we get interest rates.
Are you buying more Tesla? Are you buying more Roku? And then finally, I'll throw them all together. When we spent some time on the stage at the SALT conference about a year ago, we talked about Bitcoin. It's about $20,000 right now. You said you thought back then, 5 years' time from now, it could be $500,000. Do you stick by that? So Tesla, Roku, Bitcoin.
Cathie Wood believes the market has completely disconnected with reality and that both inflation as well as interest rates are going to surprise to the downside, propelling innovation, tech, and crypto much higher. In a recent interview on CNBC Squawk Box, ARK Invest CEO Cathie Wood breaks down market conditions and why she believes we're going to see month-on-month deflation as well as a much more dovish Fed leading into the last few months of the year. Make sure to stick around to the end of the video where Cathie also shares what her position is on Tesla, Roku, and if she's sticking to her $500,000 price target for Bitcoin within the next 5 years. Also, only a small amount of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
Today, you're announcing the launch of ARK's venture fund. We're going to get to that in a second, but first we want to talk about the broader markets here in London. This morning, we saw the pound reach a low against the dollar. I want to get your sense of where we are in this economic cycle, if we could, and really, I think, given the conversation we've been having all morning, has inflation peaked? Yes.
Well, it's very interesting to hear people saying that we'll be able to skirt recession. We believe we are in a recession. The durable goods orders we just saw, really we're seeing the strength there because of activity being attracted to the U.S., a flight to safety. That's why our dollar's been going up as well. Nonetheless, we think we are in a recession. We're seeing tremendous demand destruction. You see demand for gasoline over the summer down to 25-year lows, 1997. Think about that. So lots of demand destruction, and we believe it will continue. The good news here is to hear Michael Evans this morning talking about, hey, we're all on the same page. This could be done in the first 3 months of next year. Well, if the market is the discounting mechanism that it should be, then it should be discounting the peak in interest rates. Yes, inflation peaked. We believe core inflation peaked at 5.3%. This is the PCE deflator that the Fed supposedly pays the most attention to. 5.3 in February. It's down to 4.6. And with all of the price declines that we are seeing out there, whether it's in retail because of too much inventory or way up the pipeline with commodities really falling out of bed, all of them, I think the inflation rate is going to be surprisingly low. We would not be surprised to see deflation month to month sequentially for a number of months during the next 6 months. I think they do not appreciate how much demand destruction has taken place out there. But this holiday season, I think, will be telltale that way. And so I do think we're looking at a major pivot. If we're right that deflation, and we've been saying this for a while, so consider the source, but if we're right that deflation, both for cyclical reasons and for secular reasons, all we do is look at technology and the cost declines associated with different technologies, and they're massive. We think that inflation during the years ahead is going to surprise significantly on the low side of expectations. I think they have been basing their outlook and their policy on two lagging indicators. Seems they've been paying more attention to the CPI year over year, which is still at over 8%, and employment. Both of those are lagging indicators. The leading indicators, which are all in the pipeline, easy to see right now, are all saying that prices are going to come down. Inflation certainly will come down, but I think the big surprise out there is the number of months we will see actual deflation, negative prices. And it's not just because of the U.S. In fact, we're benefiting from the flight to safety from the rest of the world. What's going on in China is highly deflationary. What's going on in Europe, the same. This energy is a huge tax on that continent. One of the other things that's happened in the last week that I think is fascinating is that both Japan and China have basically supported their currency. And they're basically saying no mas. And in order to do that, what are they doing? They're selling dollars and buying their own currency. So effectively, China and Japan are doing some of the easing that we think the Fed will do, increasing dollars in the system.
So, Cathie, what turns things? Right now, the conventional wisdom, you're already saying we're in a recession. The conventional wisdom or prevailing view is that we're headed into a recession if we're not in one right now, and it gets worse, not better. You're saying that there's going to be a turn, and I'm trying to understand what is that pivot point, the inflection point that moves things in that direction.
We think employment is going to come down and the unemployment rate up. The Fed thinks so as well. That's a lagging indicator, a big lagging indicator. And we do believe that CPI-based inflation, especially because of energy, food's sticky, no question about it, but energy prices are coming down against all expectations. I would also say, there's so much bearishness in the market. Today, we see Goldman Sachs and BlackRock saying, sell equities. Oh, my goodness. This is like, I remember, this was very early in my career, 1982, Business Week magazine on the front cover saying, equities are dead. And now you have some of the biggest houses out there who would tend to benefit from a positive equity market saying, equities, don't go there. We think that the surprises, again, both inflation and interest rates are going to be significant to the downside. And we do think, even though we are in a recession, that it won't be as extensive. It's going to be much more of an inventory recession as we get interest rates and inflation down.
And Cathie, and therefore we see the market move higher as a function of multiples which have come down, or we see earnings actually improve. I mean, when you start to look at your own portfolio, and we were looking at some of this this morning, since ARK started, the S&P is up about 81%. You're up about 83%. The mix of stocks obviously so very different, but in terms of trying to outperform the indexes, how do you think about that?
Well, for us to be even ahead of the S&P after such a trashing during the last year, you're certainly looking at endpoint sensitivity here. I guess it doesn't surprise me, but what it says is if you look out from here, if we're right, we're going to take off from that 83%, and we believe much faster than the S&P 500 is for two reasons. One, we're focused on the right side of change, innovation, disruptive innovation. And two, the traditional benchmarks are very backwards looking. And so what is disruptive innovation going to do? It's going to disrupt them. So I would expect the gap to widen significantly from here.
Cathie, you're announcing a new effort today with Titan around investing in private companies. Speak to it, because a lot of people would say that this is a terrible time to be introducing something like this, and other people would say this is a fabulous time to be introducing something like this. But in terms of people's risk appetite, how do you see it? We're
doubling down on innovation. As you can see, we're delighted to be launching with Titan, an Andreessen Horowitz funded company. So we are now moving, ARK is moving from social media and social marketing into social distribution, direct to consumer. So pretty exciting. We are offering investors something they have not been able to access before. Non-accredited investors, meaning they don't meet income or asset thresholds, have not had access to private companies. We want to make sure, that's the biggest question we get when we are out there talking to our clients. Why don't we have access to those kinds of companies. Our knowledge is such, and it's true, if you used accreditation, if you used knowledge as the metric, they would be the accredited investors. And they're going to do their homework, and Titan's going to help us help them do their homework by continuing to give away our research and exposing them to the management teams and incredible opportunities in both the public and private. At a steady state, we would expect it 75% private and 25% public. And the reason we're doing it this way is we're giving investors something else they have not had prior. Those invested in our private-public crossover fund will be able to get liquidity once per quarter, up to 5% of the total fund. And so we do want to have some larger, more liquid stocks in the innovation space, truly disruptive innovation, that is, in order to provide some of that liquidity. And, you know, we also have, we're giving our platform to the private world, and we've been working really well with other venture capital companies who are interested in exposing some of their companies to investors who are not accredited in their world. So pretty excited by the advisor team we have, the network we have, the research that we've been building over the last 9 years that we give away to help people understand how rapidly and profoundly the world is going to change. I think one of the reasons that innovation broadly has been hurt significantly in the market is the inflation and interest rate environment. If we're right, and inflation and interest rates are peaking, are in the process of peaking, inflation surely, interest rates, the Fed seems to want to go again. But if we can see the end of all of this, as perhaps economic activity weakens and what's happening in China and Europe impacts the U.S. as well, I think that the market will be looking at lower interest rates. I think that's key. And as I mentioned before, we think that it's going to happen. And one other thing, Andrew, I'd like to add, in terms of access, on the Titan app, investors will be able to gain access to public, but especially private companies for a minimum of only $500, as opposed to millions and millions it might take to access these sorts of companies in the traditional venture capital space. It's pretty exciting.
Hey, Cathie, we got to run, but I guess get two sort of rapid fire questions. Are you buying more Tesla? Are you buying more Roku? And then finally, I'll throw them all together. When we spent some time on the stage at the SALT conference about a year ago, we talked about Bitcoin. It's about $20,000 right now. You said you thought back then, 5 years' time from now, it could be $500,000. Do you stick by that? So Tesla, Roku, Bitcoin. We
stand by all of them. We've been buying Roku, and you can see that because we disclose our holdings every day. I think our last move on Tesla was a buy. As you know, we trade around it, and it actually has held up a lot better than most of our other names because it is in the broad-based indices now. So we have used Tesla to trade around, but it is our top holding still, and our confidence couldn't be higher. As we see the movement toward electric vehicles accelerate. We're pretty excited about the next 5 years. I think this year there will be almost 8 million EVs sold around the world. We think that goes to 60 million in 5 years, and we think Tesla's in the driver's seat.